Free cash flow is up 500% from 2022, from 1.6 billion to 9.5 billion. And investors who invested in Netflix over that period made 4 times their money. And that is despite the stock now being down 30% over the past few months. Now, in this video, we are going to break down all things Netflix and ask the question whether or not Netflix is now a more mature company that has fewer growth opportunities, or whether or not this 30% stock drawdown could present a good investment opportunity. Now, not to hide the lead, I am going to argue that a lot of the easy fruit for Netflix is done. If you go back just a few years, their cheapest ad-free plan was $9.99. Now it is $17.99. So they've already raised prices a lot. They also have cracked down on password sharing, which was a sort of one-time gain in a lot of users. They also have now introduced advertising to the platform, another sort of benefit. Now, all of these things were key to Netflix growing their free cash flow over the past few years, but they still have a lasting advantage in the secret of their business model and why they are successful, which I'll tell you right now has to do with their low content cost per subscriber. So we are going to talk about that, the business model, what I see to be their sort of 4 opportunities. The first one has to do with building out their advertising platform and their ad tech stack. These are sort of more in-depth details that I don't see a lot of other people talking about right now. The second factor has to do with the Muse Platform. This is a sort of in-house tool having to do with an algorithm that could potentially increase time spent. We'll talk more about that. The third is churn reductions and different things they're doing in that area. And the fourth comes back to this content cost per subscriber and why this structurally advantages them versus a lot of competition. And then the fifth thing has to do with the Warner Brothers acquisition, which may or may not happen, but we are going to still analyze it in detail at the end. We're going to put a lot of math and valuation around a lot of this. And so you can look at the timestamps below if you want to skip around. Now, at the same time, though, we know they're trading at 33 times trailing earnings. So we still need a lot of growth to happen in the future in order for an investor to make a return on their investment. But we also know at the same time that at least historically, the drawdowns in Netflix have presented interesting opportunities to at least look at the stock, which is exactly what we are going to do today. Now, you might be wondering, why should you listen to me? And so my name is Drew Cohen. I used to work at Goldman Sachs in investment research. Later, I moved to the buy side working at Capital Group. And now I am an investment advisor. And I also run Speedwell Research, which produces in-depth research reports for long-term investors that I sell to various hedge funds and investment managers. Now, you are probably familiar with the Netflix business model, and you yourself have probably used it before. Now, if you're based out of the US, you probably pay anywhere from $7.99 if you're on an ad plan to $17.99 for the standard plan or $25 for higher quality. That is basically how their business model works. It's a subscription model. But the secret of their success and the reason why scale has been so advantageous to them, and they've seen such strong free cash flow growth over the past several years, has to do with the operating leverage embedded in the model. Now, the key difference between Netflix and we'll say YouTube or even Spotify is that when more people subscribe to Netflix, it doesn't cost them anything to serve the content. And so as a result, their content cost per sub actually drops. In contrast with Spotify, it's a revenue share agreement. So every time someone signs up, they get that money added to a pool. And as they listen to songs, it's kind of a fixed rate how much is going to be paid out. So they don't get that same sort of operating leverage. It's similar with YouTube. YouTube pays out 55% of all ad share revenues. And so with Netflix, one of the key reasons why it has been such a different business model and so much more profitable as it's gotten so much bigger is that all of these incremental subscribers they've been adding over the past few years, you're talking about over 100 million, a lot of that profit went right to the bottom line. And that's not going to change in the future either. If someone signs up for Netflix today, let's say they're paying $17.99 a month, they have very little incremental cost associated with that. Their gross margins are probably 80 to 90%. Sure, it's kind of expensive hosting the servers and the bandwidth and all of that, but they're not paying anything more for the content, which is a key piece of their business model. They own the content, or when they're licensing it, there's usually not any sort of aspect where they're paying it out based off of how successful it is. And so that is why they've been really enjoying a lot of operating leverage. Now, many people though think of Netflix as a TV streaming streaming platform. And sure, that's technically true, but as of now, and as especially of late as they moved into advertising, they should be thought of as an entertainment platform. They are no longer just fighting the TV streamers, they are now fighting a different battle. And that is the battle for time spent. And that is because they no longer are just monetizing based off of subscription fees. They're now monetizing based off of advertising, which monetizes based off of how much people actually use the service. Because the more you watch, the more the opportunity they have to show you ads. And so this is a slight change in their business model versus historically. Additionally, the competitive landscape has changed as well. Right now, their biggest competitor is really YouTube. And a lot of people are now watching YouTube in their living room on their TV. In fact, I can see on this YouTube channel that roughly speaking, about 20% of you do watch these videos on your TV. And I would imagine for, less information, more, entertaining, fun content, it's probably a little higher. Not that we're not having a lot of fun here, but that is a big shift in the competitive landscape. And so right now they are fighting for all sorts of time spent. And it shows in their investor letters, which are now quoting different time spent statistics, which are up 2% on global hours watched year over year. And while it's not a big focus of them, they have rolled out games and podcasts too, and all of that could also be thought of just as another way to keep people in the Netflix ecosystem. If someone playing a game on the platform keeps them from leaving and going elsewhere, maybe there's a little bit of a churn benefit, it makes it worth it. But that is also though why they're not just focusing on time spent, but also what Greg Peters, the CEO, is calling quality engagement. Because there's sort of two different variables they're trying to weigh here. Yes, on the one hand, they need time spent to be high for the advertising tier, but that's not that big of a business. Right now, it's only $1.5 billion in revenues versus the 45 plus billion in revenues they have in subscription. And quality engagement means that you're really enjoying your time on the service and you're less likely to churn. It's not the sort of, shows you're just putting on in the background while maybe you're doing the dishes or running around the house. It's something you actually value and can keep you in the sort of platform. And so that is why they're also looking at this other metric of quality engagement. They don't really disclose what that is, but they'll talk about it qualitatively on the call. And so there's these two things they're balancing in their business now. There's the subscription revenue and the advertising revenue. In the future, though, I would imagine advertising is actually a much more important business for them. If we look at YouTube, YouTube makes about $40 billion in advertising revenue versus $15 billion in subscriptions. And of course, for Netflix, that's very, very flipped with $45 billion in revenues and just 1.5 on advertising, which, even though they say is going to double next year, it's still just a very small amount relative to what it could be. So what could really unlock all of this advertising revenue has to do with their ad tech stack. Now, if you remember, ads are a pretty new thing for Netflix. They just rolled them out in 2022. They didn't have sort of this professional ad apparatus that, Meta has, for example, where there's a lot of advertisers that can go in to a dashboard, they can onboard there, and they can programmatically buy advertising. Instead, it was very manual initially, and they relied on a lot of Microsoft technology as sort of a patchwork solution in the meantime. And that got them an entrance into the advertising industry, but that was not a good way to fully monetize their assets. And so what they've been doing is they've been working on the Netflix ad platform. And what that really is something you would never see as a consumer, but in the back end, advertisers now have a much easier time onboarding and managing their ad purchases. And so before, it was pretty manual. And some of this also has to do with the legacy ways advertising was purchased on TV. There's something in advertising called the upfronts, which is basically, sometimes a year before advertising is ever shown on a TV, they will pre-sell 70% of their ad slots and then reserve the rest for kind of more just-in-time advertising. That's the way kind of traditional linear TV worked. Now with digital advertising though, that doesn't need to be the case, and that's also not the best way to monetize it. Instead, the best way to monetize it is you get as many advertisers as possible in, and you have them bid against each other for ad slots. Now, if you're not familiar with Meta, that is basically why they are such a powerhouse of an advertiser. Advertisers onboard onto their advertising platform, they give them money, they give them an objective, and then Meta figures out how to best spend that money. Now, if Netflix can get to that point where they now also have a lot of data on all of their subscribers, and so they can better match ads to who is watching the shows, and there's a lot more data, of course, when you're watching something digitally than when you're watching it on linear TV, all of that could make their ads more valuable. Now, I'm not going to say, though, that ad pricing, which is the price that they sell their ads for, is really an opportunity for them, because it doesn't seem like it is. In fact, right now, their ad pricing is kind of at the high end. Some numbers I've seen is that they're charging $40 CPMs. CPM is short for, cost per mile, but what it really means is basically cost per 1,000 impressions. And so right now they're charging about $40 for that, which is at the high end of premium TV. For, contrast, on YouTube, maybe they're doing $8 to $10 CPMs for a lot of YouTube channels, maybe 15 to 20 for premium. And so it is already a premium price people are paying to advertise on Netflix. The problem, though, is not actually the price they're getting, it's the fill rate. And so what ends up happening is they have ad slots, which are opportunities to basically show ads to viewers who are, sitting at home watching TV, and instead no ad comes up because there's no advertiser that is taking that slot and paying them for that. And they've talked about that on the last call, how they've been improving their fill rate, but that is a real big opportunity for them, is just getting more advertisers into the ecosystem. Right now, they already manually reached out and have a lot of, the Fortune 500 sort of brands, but getting sort of that long tail of advertisers to come and advertise on Netflix is what is really going to allow them to have a much broader variety of inventory. There's multiple benefits to having more inventory, though. It means you could better match an ad to someone who actually might enjoy that ad. And again, the more data allows them to actually target that better. And so it's not the most exciting thing that people are talking about. And as a consumer, I'm not thrilled about the idea of watching ads and all that, but that is a very big way a lot of people can afford to watch TV, is that they just watch the ads and don't end up paying as much for it. And I think the corollary point to all of this is that once this ends up happening, that their ad apparatus gets a lot better, I think they're going to have a tier that is entirely ad supported with no subscription price. And I think that will really unlock a lot of growth for them. Because if you think about it right now, they're charging $7.99 for the ad tier. And if you go up to standard, it's $17.99. That's a $10 difference, right? But they're currently not monetizing the users well enough to get $10 in sort of ads per month per user. And so what they're kind of doing right now, I think, is that they put that subscription price on the ad tier. That's kind of a floor. They're building up their ability to basically show ads, monetize that way. As it gets better and better and reaches parity with the $17.99 plan, they could do one of two things, or probably both, honestly. They'll probably continue to raise the pricing on the standard plans that don't have ads. And that means that if someone will kind of get priced out of those, then they're going to fall back into an ad plan. Or, conversely, they'll just take the price hike, which is a win for Netflix. And then I think at the very bottom, they're going to have a tier that doesn't have any subscription price on it at all. Similar to how YouTube is, right? You log into YouTube, you could just watch. You watch with ads, though. And if you want to get rid of the ads, then you have to pay more money. And I think that's something they might eventually go to, but they can't do that until they can monetize viewers well enough that they're not really losing money if, someone was a paying subscriber and then they switch to advertising. And so I think that is going to be a big unlock and growth opportunity for Netflix. These sort of advertising opportunities, they tend to be very, very long-term opportunities because it takes a long time to get really good at the ad targeting. You can always improve it. You can always get more advertisers in there. And then at the same time, you're getting more users in there. If you're increasing the content and the engagement, then you're increasing the watch time. You're increasing the inventory they have available to sell. And so all of that is really kind of a big unlock for them. Now, one last nuance to this, though, is that, and this is a negative, it's that when you are watching TV, you're kind of laid back and the ads are kind of on in the background. And so the advertising that tends to show up on TVs are called brand advertising. In contrast, if you are on Instagram, it's called direct response advertising. And that's because it's an ad with kind of a direct call to action. You might see, a pair of sweatpants or, some supplement or something, and you go ahead and click in and you buy it right there. And because of that, and because they can attribute the sale to the user at that point, they can do math to say exactly what the return on ad spend is for the advertiser, and that makes those ads worth much, much more typically than brand advertising. Now they are doing some interesting sort of experiments where there's now, kind of buttons you could click on the ads to make them a little bit more engaging. And I would venture to say again, this could be a step in that direction of wanting these ads to potentially, I don't know that they're ever going to fully get there, but to become more interactive so that they could maybe ascribe some sort of action from the user to the advertiser to show how effective their ads are basically. But even if that doesn't happen, a lot of advertisers want to be on Netflix because they have a huge audience and people still want, sort of brand advertising units. And it's kind of become a go-to place for that, especially because it's more brand safe than something like YouTube where it's kind of hard to check the content of what's actually being created. When I actually upload these videos, I attest myself that, there's no violence or bad words or anything like that. And so maybe that by and large works, but for certain brands, that's not going to be sufficient. And they only need one horror story of one of their ads being against some very unsavory content to pull their ad spend. And so that's why Netflix has become a very popular ad venue, and I think will become even more so in the future. Again, remember, YouTube ad revenue is over 40 billion versus subscriptions at 15. There's just a lot more money to be made in advertising because there's a lot of people that don't like paying for stuff. And so despite the fact that Netflix has 325 million subscribers, think of how many users there's on TikTok. You're talking about a couple billion. Would some of those users instead throw on Netflix maybe if it was free? Yeah, possibly. And so if they could get to the point that they're monetizing that time spent high enough that it's not a loss for them and that they're worried about people downgrading from the subscription to the ad-free tier, then I think that will be another unlock for them. So that this is kind of the advertising opportunity. And it kind of bleeds into this next thing, which I was mentioning at the intro, the Muse platform. And so this is an internal tool they use to basically recommend titles and help the algorithm basically better recommend you content, but it'll also kind of change the thumbnails, the previews. It'll change the different entertainment assets to better match your personal preferences to make it more attractive to you. And so it's kind of funny because this is similar to YouTube in a way where YouTube tests a lot of different thumbnails, even on certain videos, all A/B test different thumbnails. And what that allows the system to do is to find the content that best resonates with the user. So you end up staying on the platform. You click and you watch. And so Netflix never really had that great of a recommendation system that was live and reiterating in the past. And they talked about this. They would do all their recommendations the night before, it'll load into the system. And so when you open up Netflix, that was the recommendations you get. As you watch stuff and you would like star it and rate it, that would go into the system. And then you'd open up the app the next day and it would change. It wasn't as live though as you think about a TikTok feed where it's constantly just iterating your algorithm. And so Netflix is really trying to get good at this because you've probably experienced yourself when you sit down and you open up the Netflix app, you scroll through a little bit, you don't see something and you switch, you go to Hulu, maybe you don't see anything, you go to, the next one, Apple TV or Amazon Prime, and then you finally find something. That is lost viewing opportunity for Netflix. And so once you're in that Netflix app, you've already shown that you have an intention of watching something and they need to be able to surface something to you that you want to watch. It's kind of like imagine TikTok, but like without the algorithm or with a really janky one. It wouldn't work as a business. And so this is another leg though that Netflix has up on the competition, and it's for two big reasons. One, the competition just can't invest in the tech stack the same way they can. It's just something that they have much more money to do. But in addition to that, they also have much more content because the algorithm recommending stuff is useless if there's only 300 TV shows to recommend. Instead, they have a massive library that continues to grow, which means that they'll have more stuff to recommend to you. And this could also, feed into the actual content they end up greenlighting so they could actually better know what people want to watch. And so all of this together works with Netflix. And I would imagine, just as a consumer, you probably noticed yourself, you log into, the Disney Plus app, something like that. It's kind of, a dumb app. It doesn't really do all of these very smart recommendations. And so Netflix is just starting to get better and better at this. And this is a big focus for them. And if they can increase the amount of time people open the app and actually watch something, over time, that's increasing quality engagements, going to decrease churn. So more subscribers. In addition to that, increased time spent on the advertising side that can increase revenue per user. So that is the next opportunity for them. Now, the next two things are the churn reduction aspect and then the content cost per sub being less. Those are kind of the competitive aspects. Before I hit on that though, I want to talk about the Warner Brothers acquisition because it's going to both kind of feed into these aspects of the business. And so we don't know for sure whether or not the Warner Brothers acquisition is going to come through, but they have accepted it. It's an $83 billion acquisition. It's going to be all cash and Netflix is going to take on, some maybe $60 billion in debt to fund it. But in turn, they are getting a lot of assets. They're getting IP, such as, DC Comics. So they could create their own, superhero universe, potentially rivaling Marvel's with Disney. They also have Harry Potter that they're acquiring. Then they get a lot of these, like sit back, lay back TV shows, stuff like Friends, The Big Bang Series. And then, of course, kind of the crown jewel of it all is HBO, which is not just all of the series, which count among, some of the best series ever produced. Stuff like Game of Thrones, Sopranos, The Wire, Entourage, Curb Your Enthusiasm, a lot of TV that people love, and movies as well. But they also get the HBO app, as well as, there's some 120 plus million members there. And so that is kind of the big aspect of this acquisition. They get a consolidated competitor. Now they're no longer bidding against content against a competitor. And so it's just a little bit more benign of a competitive environment. 2, they get the IP, which isn't just like the existing TV series. It's the potential to create more off of the IP. And when you're creating, a TV series or a movie off of existing IP, it tends to get easier to get people to watch. There's, less risk involved in that. 3, they're getting this massive existing library of content. And then 4, they're also getting, that HBO app and their members I mentioned. And then we could also say 5, they're also getting a game studio out of Warner Brothers, which, could be potentially interesting as they talked more about getting into games. And so they can now use Netflix IP for games as well. And so that's something that, kind of just exists there as a potential opportunity. They haven't said much about it, and we really won't either. But those are kind of the 5 pillars of the acquisition. Now, the most important part, though, of course, is HBO Max. And they've been very tight-lipped about what they're going to do with this. It's not clear whether or not they're going to keep it as a separate standalone app or combine it within the Netflix app. What I would venture to guess they're going to do is they're going to combine it, because that just makes the most sense. And the reason why, if you think about, the super app strategy, not that I'm saying Netflix is a super app, but the idea behind a super app is that if you have multiple services housed in the same app, it's less friction to get a user to try the incremental service. And there's a lower customer acquisition cost of it too, because you just have the opportunity to throw up, blurbs, and it's just a tab there. And eventually people get curious and click it. And so if you think about what was going on with Uber, they used to split up Uber and then Uber Eats. And then they're like, that's not the best idea. And so they put Uber Eats back into Uber. Yes, it's still a standalone app, but they're trying to emphasize the Uber app more because they realize having one app builds more loyalty, more consumer engagement. It also works better now that they have the subscription. And so all that, it's kind of similar to Netflix. And what I would imagine they would want to do is they would have Netflix, and then maybe there's an HBO tab. And so now whether they charge separately too for HBO or it gets included, that's another question mark. Let's say that it's a separate plan though, and it's just kind of like the premium add-on plan for people. They could charge, $25 a month for Netflix as they do currently for the premium. And then they say you want HBO, it's a $20 add-on. It's right in the same app. So you see that tab. And then also, okay, well, if you don't want to buy it, there's ad versions for you. Maybe a version that has no subscription charge at all. It's just filled with a lot of ads. And so that's one potential for them. And they also have the ability to give, one episode away for free. And so you test it. If you like it, now you're kind of stuck. Do I, subscribe, or maybe I do an ad-free tier, something like that. It just makes sense to me that it all stays in one app. There's one login credential. You're not downloading multiple apps because, everyone forgets the streaming passwords and accounts get logged out. And so it just adds a lot of friction to the experience. I don't know what benefit it would really be to have 2 apps. And so to me, it makes sense you make it one app and then you try to cross-sell people to HBO if you're not going to combine it. Potentially, they just make everything included in the Netflix app. They charge even more for it, and then they have an ad tier for people that can't afford it. And so maybe they even do different ad tiers. One is loaded with a lot of ads, one a little less. They have a lot of different options to do, and the way Netflix kind of works is they just experiment, and they'll see kind of what works the best. And we saw that where they were very, very hard-nosed, saying, we'll never do advertising, and then they backtracked on that. They said a similar thing with live sports, then they backtracked on that. So nothing is ever a golden rule there. It is a culture of experimentation, but that is just how I think it would make sense for them to play it out. But if we want to think about some math of how kind of combining the services could help them, let's say Netflix churn right now is about 2% a month. That's, an estimated rumored churn. They've never, really disclosed this number. But if they could bring that down from 2% to 1.5% a month by including more content. And by the way, maybe it's not even the HBO content. Maybe it's just like the Warner Bros. Content, stuff like, The Big Bang Theory and Friends. And I know they have some of these shows already on there with licensing agreements, but there could be a lot more kind of content in there that they could put in. That could potentially reduce churn. And if you're able to reduce churn just 50 bips, 0.5% a month, that could be about 20 million more members that are staying every year. And then 20 million members at their current, average revenue per user of about 1150, you're talking about $1.7 billion in NOPAT just from that one churn reduction. And in addition to that, it increases the lifetime value of all future members, because the less churn there is, the more valuable the member is, because they stay longer, they pay more months. It also means that they can then pay more to acquire them in advertising and such. So that's just kind of one aspect, throwing some numbers out there for the Warner deal. Now we'll get into more numbers in the valuation section momentarily, but I want to talk a little bit about the competitive environment right now. And again, going back to this idea of what is the secret of Netflix, it goes back to this low content cost per subscriber. That is the key. The more subscribers they have, the more they can spend on content, but also the cheaper that content is at the same time. Disney spends $24 billion in content a year, but their direct-to-consumer platform only generates $25 billion. That includes Hulu and Disney Plus and ESPN. And so right now, their streaming platforms are basically not profitable, or very barely profitable, if it had to support the entire content spend. And of course, they still have these linear TV stations that is supporting a lot of the business. Plus, of course, the parks and experience business. And so as a standalone, direct to consumer business, Disney is basically not profitable. And that is, one of the biggest, most formidable competitors right now. And that is because all of this money they're spending on content cannot be supported just by their existing streaming subscribers. Whereas in contrast, Netflix is making a lot of profit just off of TV streaming. And that differential right now is about $11.50 ARPU versus about $5.12 in content cost per subscriber. And so that differential is why they are so profitable now. And as they add more subscribers, what ends up happening is they get that $11.50 from each subscriber, but that $5.12 is not what they're paying per additional subscriber. That's a fixed fee. And so instead, as more subscribers join, that number actually drops. And so that is why this model is so powerful, why there's so much operating leverage in it. In contrast, if you're looking at someone like Paramount, they spend, $16.5 billion in content a year, but they only have 80 million subs. The amount of content cost per sub for Paramount would be $17.80. And so it's more than 3 times higher. So it is just not a structurally profitable business. And so they're all playing this game. All these traditional TV streamers are playing this game where they're using the cash flow from the old linear TV to try to subsidize the content spend while they grow their direct consumer business, the streaming business. There's a problem with this though. For starters, the linear TV business, the traditional one, was more profitable than streaming. Disney right now makes about $9 in revenue per user on streaming versus about $13 for traditional TV subscribers. That is a big revenue loss for them. And so what they're doing is they're trading off more lucrative TV streaming for less lucrative streamers, where at the same time on the streaming platform, they also tend to have worse churn and higher customer acquisition cost. So they're going from a really good business to a worse business. And this is just kind of a legacy constraint that they all are trying to navigate and why they are all really struggling. Disney had as much profit in 2018 as they did in this year currently. That is a crazy fact. 7 years later, profit is unchanged. It's actually much worse though for other competitors. Warner Brothers has $500 million in profit versus $2 billion in 2018. Paramount has half the profit now they had in 2018. And so it is just a structural issue that they are undergoing, because when they were on TV, everything was bundled together, which meant that you couldn't cancel just one service and people weren't going to cancel their entire TV. And so everyone just stayed on, kept paying, and they kind of had a captive customer. You were kind of screwed if the TV bill went up. You were unlikely to cancel TV. And at the same time, there's a lot of content you were paying for that you didn't value, but that you were paying for it nevertheless because you wanted to get the stuff you did value. And so when everything got decoupled, people were now only paying for things they valued, and they found out that a lot of stuff was not valued and people were not willing to pay the same prices they were before, when there was free choice and when it was very easy to cancel and resubscribe. And so it just made it a worse business model. Now, Netflix, though, grew up in this dynamic. So a little bit how Amazon would talk about how your margin's my opportunity. They were never this big, cash flow gushing profitable networks business. Instead, they were, originally a DVD business, but then they were, a deeply in the loss TV streamer. And so when they did finally become profitable, it was all a benefit for them. They were more structurally built for this environment because they don't have this legacy business and they were never overcharging in a way users. And so coming up from this sort of different dynamic means that they're just structurally advantaged versus the competitors. And there's a lot of them and they're struggling. Amazon Prime, we didn't touch about. That's because we know they're in a different sort of game. They're more about having a TV service that reduces churn for the Amazon Prime program so that you ultimately end up staying an Amazon Prime member and buying their retail. So Amazon Prime doesn't need to be a big profit pool for them. However, inadvertently, it kind of has, as advertising has turned on there too. They also have a benefit with advertising because they have a pretty good ad tech stack and they have all these relations with advertisers and they could cross-sell advertising between their main platform and the TV. So basically they're playing a different game. And so are they, a competitor to Netflix? Yeah, of course they are, but it's not that direct of a competitor because at the end of the day, they're not trying to become the biggest TV streaming platform. They're trying to reduce churn on the Amazon Prime program to continue to dominate internet retail, basically. And so it's a different game they're playing. But sure, they bid up content against each other. And maybe there's some people that say, Amazon Prime is good enough for me, I'll cancel Netflix. But more and more now, as they get more and more content, it's not really going to be the case. But as of now, most people, they do subscribe to multiple streaming services. Netflix kind of tends to be a core one, maybe with Hulu or Disney Plus. And then you have kind of the ancillary ones that people will subscribe, unsubscribe, and those kind of tend to have the most churn. And so what Netflix wants to do is get to the position that people just keep Netflix always on as kind of the main go-to destination. These other platforms are likely to exist in some capacity, but it's also possible some of them say, the math of this just isn't working out. It makes more sense to just license content to Netflix, which is what has been happening more and more lately. So the gist of it is, in one sentence, Netflix can spend more on content and it still costs them less. Since 2020, revenues grew $20 billion and content costs grew only $3 billion. That is all incremental operating profit, that difference. And so really powerful model they have going on. But isn't that priced in? Don't people know about this already? Well, as I mentioned, it's at 33 times trailing earnings, which is a price the stock trades at when, most people think it has a pretty bright future, generally speaking. So we'll talk about some of the math and expectations. At this current $85 stock price, $360 billion stock market valuation. So the first thing we're going to do is look at Netflix's standalone, and then we're going to throw in some Warner Bros. Math, different ways we could think about it with the acquisition. Now, right now they have about $11 billion in earnings. And so that's where we're getting that 33 trailing multiple from. They've been growing revenues on average, in the mid-teens for the past several years. Yes, they had a couple years where revenue growth was in the low single digit, 2022, 2023, and then it inflected back up with the ad plans, the price hikes, and all that. And so a little lumpy, but still around mid-teens, high teens revenue growth over the past few years. Now, on earnings, with all that operating leverage, earnings have been growing even more, closer to 20%. Now they have operating margins of almost 30%, which is a crazy stat because a decade ago, it was 4%. Now, let's say, though, that you're comfortable that they can grow earnings 15% for the next 3 years. That is going to get us to about $17 billion in earnings, or an implied multiple of 21 times. Now, at that point, it depends how much they're growing 3 years out. This is, again, the standalone valuation. If you want to say a 25 times multiple, okay, that's kind of assuming they're going to grow double digits for the next several years. If you're more comfortable assuming a 30 times multiple, then you believe that they're going to grow, mid to high teens. And so those multiples, what you do is you take that 25, you divide by the 21 times, that'll be 19% upside. Or you take the 30 times, you divide by the 25 times, that would be 42% upside. And so that's just one way you could kind of think about valuing kind of the standalone Netflix business. Now we're going to layer in Warner Brothers, and there's kind of three sources of earnings from Warner Brothers we're going to talk about. We're going to talk about HBO Max kind of subscription revenue. We're going to talk about kind of the legacy studio business they're acquiring as well. And then we're going to also layer back in kind of that churn reduction benefit I mentioned, that 1.7 billion in earnings we talked about. That could happen if they took churn down from 2% to 1.5%. So the HBO Max subscription, That right now is a lower ARPU business. So that's actually part of, the upside here. They do about $7.15 ARPU. By the way, the reasons why these numbers are so much lower than what you're paying is international monetizes much, much less. And so these are all in US dollars. There's purchasing power parity. Prices, they basically can't charge as much in other countries because they're not as rich. So HBO, $7.15. Let's say though that through advertising that they could take this up to $10. And the reason why I say advertising is they do have currently an ad tier. It's kind of suffering from a similar problem as Netflix did earlier on, just not enough advertisers in the ecosystem. Ad load just isn't as high as it could be. And so that's an opportunity to better monetize the service. And you could include price hikes in there as well if you want. So let's say that $7.15 can get a little closer to the Netflix ARPU, but not totally, of $10. And they have 120 million members currently. That math right there gets about $2.9 billion in NOPAT, operating profits after tax. So that's the first source, the HBO Max sub revenue. Right now, the studio business, making content, theatrical releases, the licensing, the distribution there, that's about a $1.5 billion business. Now, they're not acquiring any of the legacy channels or anything like that. And it's a little hard to get this exact number clean because that's not how they segment stuff on, the 10K. It's not, this is the stuff Netflix is buying earnings. It's all kind of grouped together, but they do have a studio segment. That's what we're basically taking. I think it's roughly approximately right. So that's $1.5 billion there. You put those two together and that gets you $4.4 billion in NOPAT for Warner Brothers. And that's like kind of what I think they could be doing, let's say 3 years out, because it'll take them a while to raise the ARPU on the HBO Max prices. So that gets you an implied multiple of 19 times on this acquisition. So it seems like a pretty fair multiple to be paying. But again, this assumes, some business improvements and all of that. And also the studio business is very volatile because bad theatrical release and you could get almost no earnings and it's lumpy. And so not a very high quality business to begin with. So that's the one aspect. Then you layer in the 1.7 billion that they could get from the churn reduction. And now you got to 14 times. And so that's with the synergies from that a little bit better. And, they talked about $2 to $3 billion in cost savings from this acquisition. And so all of that numbers it roughly makes sense with, management commentary as well, because I was assuming with the HBO subscriptions, they're making, closer to Netflix like margins, we'll call it 25%. And so that is just one way we could think about Warner Brothers as a standalone business, what is the price they're paying for it? How does that valuation look? What are some synergies? So that's one way, it gets down from a 21 times multiple to maybe 14. These numbers though, I'm just throwing out sort of estimates here. The estimates aren't really worth that much though. What really matters is the context and everything else we're talking about, because whenever you put a number out, there's always, probability distribution around it. And so, things could of course be better. Of course they could be worse, but it's more about the math and kind of getting an idea for this. And then you can make your own assumptions with this, but just helping you think through different ways you could look at that deal. So that's just the deal on a standalone basis. Now, just before we combine the kind of math between the Netflix standalone and Warner Brothers, we have to keep in mind they could be taking on around $60 billion in debt, 5% interest rate, maybe it'll be higher, I'm not sure. That's about $3 billion in annual interest expense. So that is a lot of leverage being added to this business. And so you take those two numbers, we talked about the 17 billion from standalone Netflix, plus this 6.1 billion estimate we got for Warner Brothers. And then you layer in this 3 billion of interest expense. And now we're getting about $20 billion in net earnings. Now we're going to want to take the two kind of market caps of both companies. Netflix, 360 billion. We're going to call Warner Brothers 83 billion. That acquisition price we're going to take, that's fine for our purposes. And putting those together in that $20 billion earnings estimate 3 years out, and you get a multiple of 22 times. And so this is, an estimate, right? I'm not trying to say this is what's going to happen. I'm just trying to think through different sort of math, but that's a 22 times multiple, 3 years out earnings. And at that point, maybe you want to apply a 25 to 30 times multiple, assuming if you think they're going to grow double digits to high teens. If it's a 25 times multiple, that's 13% upside, whereas if it's a 30 times, that's 36%. However, a lot of risk involved in this, and also a lot of sensitivity in this model. Keep in mind, and this is the power of Netflix, but also why it's hard to kind of estimate earnings. And you don't know if this could happen in year 2, year 3, year 4, or sometime thereafter. But let's say in 3 years, they have 400 million members and they jack up prices an average of just $1 per member. Do you know how much earnings that generates? That generates $3.7 billion in earnings. And if you just throw, a 25 times multiple on that, that's $90 billion in enterprise value being created. And so that's just one way of kind of caveating I don't want you to think even I think any of these numbers are certainties. I just feel like I have to give you some sort of numbers out there so you have some idea of how to analyze the deal. Of course, there's all sorts of different ways to analyze this. And we talk more about this too in our newsletter. We're going to have a post just on Netflix coming out. If you subscribe to drewcohenmoney.com, it will be linked in the comments below. But that's another sort of insight you could get on the business and all that. But there are other risks too. Keep in mind that 60 billion is a lot of debt. That's one thing. Forget that though for a second. Big acquisitions have a very bad track record. There's very few times a company can absorb such a large business and it doesn't kind of make the culture worse off, the integration worse. It really just tends to not work. In fact, there's very few examples of large acquisitions ever working. And so the base rate, honestly, of a Warner Brothers acquisition is that somehow it kind of erodes a little bit of Netflix's culture. Now, I'd like to be optimistic and think that, they still have, their founders involved and they have a very strong culture, a very strong vision, a very strong model. They'll be able to overcome that, but it's hard overcoming sort of institutional bureaucracy, the way people have been doing stuff for literally multiple decades. And so it's not an easy thing to turn around. So all of this could mean that actually core Netflix gets distracted, they slow down, everything looks worse for several years while they integrate. Maybe there's just problems that we can't even foresee. All sorts of issues with maybe integrating the different services. And there's other issues that maybe it's just hard to foresee as an outside analyst. Now, another thing to keep in mind, and we briefly mentioned this, is international ARPU, where there's going to be the most growth is internationally. International ARPUs, they don't monetize as well. That's not just on subscription pricing, that's on advertising as well. And so that's going to make future growth just harder and harder. And in addition, you would imagine their best subscribers and that people that love watching TV the most are already subscribers to Netflix and its TV streaming services. It's not like people are strangers to the idea of what Netflix is. And so if they're not a subscriber, they probably have a reason why. Now, maybe some of them just don't have the money to do it. And so an advertising tier unlocks a lot of that. But it's also possible they just don't care that much about TV. And there's all these other ways to entertain yourself. And in the future, it looks like there's going to be even more with AI. And AI can help people make a lot of content. It can help people on YouTube make more compelling content. It's not so great right now, but it can make YouTube an even more fierce competitor to Netflix, as well as all the other apps like, TikTok and Instagram. And those apps too are now starting to show up as apps on the television screen, further directly competing with Netflix's home turf. And now, if you watched my videos before, you've noticed some people maybe complain that I don't tell you what to do. I don't conclude this video by telling you it's a buy, it's a hold, it's a sell. I don't do that because I think the real key to being a good investor is understanding that there's all sorts of different outcomes that exist in figuring out how to weigh all of these different potentials and the returns. And I try to give you an idea of what the returns can look like and whether or not you see the risk in the potential returns are worth it, because ultimately this is an educational channel. I'm not here to give you financial advice, and I can't because I'm a financial advisor, but I want you instead to learn how to analyze a business, how to think for yourself. And if I missed any aspects of the deal or analyzing Netflix, that's very possible. So go ahead and drop your comments below. I'll try to answer all of them or maybe make future videos about Netflix. But if you're enjoying these deep dives, I would really appreciate it if you hit like and subscribe so we know to create more content like this in the future. And if you want another business analysis right now, check on this one we did on Novo Nordisk or this one on Uber. And thank you for listening.